5,720 is where the Nifty is starting. It's absolutely flat. Nifty Bank at about 57,800. Again, absolutely flat. Bank Nifty, the Midcap index is 60 points higher. The small cap index will come up on your screen, and I think there as well, there is about a 50-odd point bump. A 0.25%, 18,430 is where we stand at. So that's the overall picture. Nifty heat map coming up on your screen, and I think it's absolutely evenly poised. Look at that, not even a 1 point change on the Nifty. And I think it's kind of balanced like that on the Nifty stock-wise as well, right? So Shriram Finance on one end, and there is Maruti on the other end. So equal number of stocks up and down this morning. Surbhi.
Okay, by the way, in result reactions, I was talking about RR Kabel. That stock's shot up 7% now. Their margin went from 4.8% to 8% in this quarter. And we'll be speaking with the management shortly to figure out what exactly has driven this. But just watch out for that. I mean, it's really an earnings bazooka out there. Anyway, large cap screen. Let's see what's moving. Shriram Finance doing pretty well, 3.5%. This is also management that you'll hear from in just the next couple of minutes. 4% up. But Shriram Finance is having a fantastic morning. Then we come to the auto majors, all of them revved up. Mahindra & Mahindra 2.5%, Tata Motors about 0.5%. Bajaj Auto's numbers just came through. They've again done over 5 lakh units in the month gone by. So about 0.5% up on that stock as well. But then it fizzles out. The Nifty is, by the way, 50 points lower. Reliance is at the flat line. It's flashing a little bit of red right now. L&T is cooling off. And then you have Eternal that's still slipping. Friday, Eternal was down almost 3%, remember? It's down another 1% this morning. There's some cool off on the likes of ITC. Then some of the bigger, stocks like HUL and TCS are, undecided, about 0.5% lower there. Maruti is slipping a lot. Maruti is down about 3%. So we'll read through the fine print on the Maruti numbers. The question is, sustainability, and that's where it's all about. The stocks rallied quite nicely, but will this post-GST bump sustain, or was it a 1 or 2 month wonder? That's the question. Anyway, that's the large cap screen for now. 60 points lower, but some green on the mid cap screens, Nigel.
Well, that's right. Zen Technologies, the stock is locked up, with a gain of close to around 5%. They've seen order inflows of around 290 crores towards upgradation of the anti-drone system and executable, and that's executable over the next 12 months or so. In fact, it's up 5.5%. It's not locked in upper circuit. So 6% higher, good move out there. Astra Micro as well, order of around 286 crores secured by their JV. Astra Rafael Cummins, that's another stock that's up close to around 1.5%. As should be mentioned, RR Kabel. That's the result reaction of the morning on the upside. But giving it company on the upside is actually LG Balkrishna. That, remember, is that auto ancillary company that has good play with regard to two-wheeler chains as well, and they've been doing various ways to re-innovate the business. The stock is up close to around 11% now as we speak. I recall we here at CNBC-TV18 had explained the company a few years ago. It seems they went to a bit of a trough and now they're coming out of it. I think we'll have the management later on today joining us, 10% higher out there. GNA Axles is another stock that's up close to around 3%. Decent volumes on that one. The reactions actually that are not very, very favorable are two of them. One is NetWeb. The stock is up close to around 30% year to date itself. The numbers look pretty okay. There is some growth on the top line. Margins as well are more or less steady, but I think it ran a little bit ahead of itself. That's the way the street is reading it. Margin steady at around 14.8% or thereabouts. Revenue growth is at 20% year on year, but the stock getting smacked. And Urban Company, that's a stock that's down close to around 6% as we speak. Big downtake on that particular name.
Okay, no, absolutely. And so that's essentially, some earnings-related reactions which are coming through. Maybe if I can just add a few more names here, which are the biggest volume-led gainers. Bank of Baroda is top of the list with the largest volume traded, 4% higher. Shriram Finance is at number 2, so financials dominating, 5% on Shriram Finance. And now that's a big, the second largest NBFC, and you'll hear from the management a little later here on the program. And there's a big reaction to results. Naveen Fluorine is at number 3. It's a 4% pop on Naveen Fluorine. So almost 5,910 on that one. RR Kabel, we mentioned, 5%. Godrej Consumer Products, Mangalam has been telling us 4% on Godrej Consumer Products, 1,170 on that one. Vedanta, you heard from the management, is a 2.5% pop coming through. And there's more. I mean, it's not for nothing. Volumes are pretty good. MedPlus is up 6%, Volumes are yet to pick up in a meaningful way, but they're not small either for this point in the day. V2 retail is 5% higher. I think that's the daily limit. There is IIFL, which is up about 4%. Intellect Design is up 7%. Intellect Design has moved up very, very sharply. Thursday's close on Intellect Design was 1,050. It's at 1,210 this morning. So Friday was a big move on Intellect, and this morning again, it's a big move on Intellect. So, I mean, there's enough and more action. Nifty has kind of reduced its losses. It's down just about 25 odd points at this stage. 25,700 on the index. Pankaj Murarka is CEO and CIO at Renaissance Investment Managers. Pankaj, good morning. Great to have you with us here. Thanks very much for joining us. Let's just start with this PSU theme, which is once again kind of sort of recycling and making a comeback, right? It was the leader of this bull market, and then it took a break, about a year and a half long break. And even within PSUs, lots of different areas which did well successively. But then, I mean, all of them largely re-rated, and then we've had a bit of a lull. But they seem to be coming back once again. OMCs, for example, is a case in point. PSU banks, etc. What do you own here, and what's your thinking about this space now, Pankaj?
Morning, Prashant. Yeah, you're right. Especially with OMCs and banks, we've seen coming back. I think the challenge with PSUs is fundamentally there's a lot of value. These stocks, despite the sharp run that we had in these companies between 22, 23 and the first half of 24, the starting point in 2022 was most of these state-owned companies were trading at like low single-digit multiples, or some of these companies were available in terms of valuation at 2 times EBITDA and stuff like that, where 2 years of cash flows just pays for the company. So the starting point itself of the rally was so low that we had a very ferocious rally. But I think the challenge with PSUs is from here on, while these companies continue to do well, the markets needs to see more reforms from governments. And I think which is where probably the anticipation is, because in case of oil companies, at least we've seen government make some clearly nuanced announcements where they said that these companies will not be forced to cross-subsidize across LPGs, and they are now getting paid for the LPG losses that they had in last year, which helps their cash flows going forward. And oil price being benign, the underlying fundamental numbers continues to remain good. And likewise with state-owned banks, where there once again, we've seen a very strong interest in Indian banks. We've seen over $10 billion of foreign money coming into financial sector in the last 8 weeks. And I think there's some expectations about some reforms in coming budget. Probably it could be another round of consolidation within state-owned banks. And I think which is what is driving interest back into these names. So from a valuation perspective, they're always cheap. I think the trigger point for PSU's rally is always the government actions in terms of reforms, because that is what can really drive a re-rating for these companies.
Okay. Pankaj, hi, great to have you on the show. So tell us on a slightly broader level whether you are looking at the portfolio in any fresh light, any major churn or changes in the last month or two as we've gone through this consolidation and with the market now practically coming back to the earlier highs.
I'll tell you what has worked for us and probably what has not worked, but what I think will going forward work for us in 2026, or how we are positioning ourselves. So clearly 2 things that has worked for us this year or in the last year has been private sector banks. They've done well, and I think they'll continue to do well. And the other is our exposure to internet companies. Again, by and large, they have done well. What has not really worked for us is our exposure to IT to that extent. And probably we were somewhat early into the consumer sector. So we've seen some moves in terms of stock price and consumer names, but I still think it's early stages. I think both of these sectors are poised for a meaningful, healthy returns for shareholders in calendar year 26. One, in case of consumption, I think the resurgence in consumption we're seeing post the festival season is actually surprised on the upside. Someone like a Maruti, they've had like 100% Y&Y growth in their festival bookings, and they're running low on inventories on a lot of car models. You have wait periods which are like 6 weeks or 8 weeks, and something like this we are seeing after 4 years. Something like this happened in 2021, post-COVID unlocks. And now after 4 years, you're seeing that wait periods on cars. So that's very pleasing to hear or, witness kind of thing, and which effectively tells us that there's a lot of latent demand that exists and consumers now have the money in their pocket. So probably this consumption recovery will sustain over a longer period of time. So I think 2026 will see a very meaningful recovery in consumption, and probably I think some point of time this will surprise us on the upside. And secondly, while IT as a sector has not done well, but what has happened is in the last 2 quarters, we have not seen incremental earnings downgrades on the sector. So clearly, earnings have troughed out. And the way macros are poised and the environment is poised, it looks like we are in for a recovery in IT spends, global IT spends going into the next year. So logically, meaning expectation is that the growth for IT companies next year will be much better than this year. And valuations are at trough, and the stocks are down about 17-18% this year, which makes from a valuation perspective even more attractive.
In fact, just keep an eye out. What's good about this earnings season is select companies report good numbers and the street likes it. Intellect Design Arena, just pull up the intraday chart of that stock. It's moved to the high point of the day. The revenues have jumped, I think, close to around 34%. EBITDA is up by 68%. And I think the company has been talking about, 20% growth in revenue in the future as well. They've been saying that they're confident on the trajectory. So just take a look at that stock, up 7.5% as we speak. Pankaj, a more general question to you with regard to the past quarter's earnings. It seems, I was looking at a Motilal Oswal note and various other brokerages as well. Till now, it appears Q2 actually hasn't been as bad as what the street had anticipated. And they're optimistic that things improve from here on, but Q2 has been reasonably better. What's your view on with regard to your reading of earnings? And also, if you could tell us with regard to asset allocation, because the frequent asked question now is how much you put in gold, how much you put in equities, how much you put in bond. If you could give us a rough matrix according to you.
Absolutely, Nigel, you're absolutely bang on. The good thing about this earnings season has been that there's been no incremental downgrades. After 5 quarters almost, we're seeing that there are no incremental earnings downgrade. And more importantly, we are seeing some earnings upgrade. So, and I think those earnings upgrade will build on from here on, because probably after having downgrade consensus earnings for almost 5 quarters in a row, I clearly think the analysts are somewhat more circumspect and need to see more evidence of sustainability of growth before they go out and upgrade their growth estimates or earnings estimate going forward. So you're absolutely right. I think we are in the second successive year for India in terms of single-digit earnings growth for the Nifty companies. But more importantly, all of us know the second half of the year, financial year, will be better than the first half. So clearly, we are near the trough in terms of earnings deceleration, and earnings have clearly troughed out. I think we'll start seeing earnings deceleration, earnings acceleration from the second half of this year. So I think the outlook for earnings after almost 5 quarters looks pretty good, and that makes me feel optimistic on the outlook for markets as well. In terms of asset allocation, Nigel, actually, I'm not the right guy because I've been a 100% equities guy all my life. So for me, there's only, so my asset allocation is very simple. A bull market or bear market, 100% equities.
All in.
All right, Pankaj, we'll leave it on that note. Thank you very much for joining us. Good to get that perspective on the markets. All in and a positive view coming in on stocks going forward. By the way, speaking of positive views, before we get to our next management, just look at Shriram Finance and how the market is standing up and saluting what is an all-round good performance. We'll be speaking to the management shortly. There is no fault you can find in the Q2 numbers. Where most lenders have reported slight compression in NIMs. They've expanded net interest margins by 8 basis points. They're guiding for as much as 15 to 17% growth. All their key segments, CV, passenger vehicle, MSME, everything is firing. ROA, ROE, everything has gone up. So it's absolutely phenomenal what they've delivered in Q2, and the market is taking note of that.
And the other one I'm looking at is Dredging Corp. Normally in a day, you see 5 lakh of volume. In the first 15 minutes, you've seen 5 lakh of volume. Oof. Massive volumes on that particular name as well, reacting to positive news flow. So the entire day's volume actually that we normally see on an average, in the first 15 minutes, it's almost fulfilled that quota. Absolutely.
So some stocks that are really on the move, and we'll get to them one by one. For the time being, let's address earnings and numbers that we saw from Kalpataru projects. That is the next management on our radar. It was a pretty good quarter for the company. Revenue growth was driven by robust execution. and it's been a pretty steady performance for them in their key segments. Amit Oplenchwar, Director at Kalpataru Projects, is with us. Amit, thank you very much for joining in. So let me just quickly go over some of the key numbers. You've actually increased your revenue guidance from 20 to 25% to now you think revenue will grow 25% plus this year. And you're also looking at a stronger order book guidance. You're saying the order intake is going to be more than 25,000 crores. So tell us where the optimism is coming in from. Which are the segments that really seem to be firing for you?
Thanks, Surbi, and clearly a great win for India, lifting the World Cup, and your T-shirt, all of you reflects that. So we've in the same line, I think we've had a great quarter. We're at our highest ever Q2 revenue and Q2 profits, and that's very heartening to know. As you said, it's been an all-round performance. Our transmission and distribution sector is doing exceedingly well. Our building and factories, the order spends on single projects are going up 3 to 4 times as they used to be in the last couple of years. Our oil and gas business has shown large growth compared to last year and the year before that. And our urban infra businesses, which we've been seeding now for the last 2-3 years in terms of building capabilities for the future, are all joining the show and contributing to this growth of the company in this quarter and at H1.
Okay, morning, Prashant here. So, so you've given us the guidance for this year. What about the top line growth? What does all of this sort of mean for margins? What's the guidance there, and what are the levers at play which could allow you to improve margins as well?
So, 3 things. First, we said we will try and get to our revenue growth so we've already gone to between 20 to 25%, and obviously we've grown to the higher band of that, and now we've guided for 25% plus at the end of the year, both console and standalone, and that obviously adds to the margin as well when you do more revenue than you had planned. We had already planned last year that, we should try and expand our margins. We said on a console level, we'll try and go 100 bips more at a PBT towards the end of the year. And at H1, we are already at more or less 100 bips more than where we were last year. We've been again focusing on balance sheet and trying to reduce our net working capital days. Our debt levels have gone down further again. We are borrowing cheaper again, getting to, contributing towards our margin profile. The execution has been very low, looking at close to 5.5% on a standalone PBT for the end of the year. Our debt to equity now on a standalone, probably one of the lowest, it's at 0.29, which pretty much debt free when it comes to our business. And I think all of these factors with better margin profiles in sectors as T&D, BNF, etc., a lot of demand in the marketplace, we're able to get better margins. And I think all of these put together are contributing towards the margin expansion.
All right. Hi, Amit. Good morning. Good to see you in. I recall having a chat with you a year or so ago at our GLS event, and you sounded very optimistic, and seems like the numbers are flowing through. So good on you. Just to focus on one segment, which is a relatively smaller part of your business, the water segment. Out there, payments, not just for you, but for various other industry players, have been slow. Could you tell us what is the outstanding in terms of payments coming in from the water projects? And also, I think, what is the trajectory with regard to here now? You were putting in some money, investing in these projects. Will you continue to bid?
So, we are cautiously bidding. We've had a small degrowth in revenue for the water business this year, and that's primarily an industry problem at the moment as we speak. The government is trying hard to unlock the past dues for us. These numbers are close to 800 crores. If you would have got these numbers, our revenue would have been even higher. The story, if you ask me, remains intact. At the end of the day, water is a huge part of being a developed nation, and I think government is fully committed to further putting money in the water sector. I think this was it happens in our business sometimes. The sector goes slow, or if you look at, except the last 2 years, the water business grew at 20, 30, 40% CAGR for most companies in the sector. So I'm not overtly worried about our payments. We are we've been guaranteed by all states that these monies should start flowing in the next 1, 2, 3 quarters. And we are confident of that. I think structurally the sector itself is solid. As we told you last year as well, we've been focused on building capabilities of the water business outside of India. We are bidding now on in a couple of geographies, and I think in the next 2 quarters, we'll be happy to give you some good news on that as well as we take our water sector more global and not just India-centric.
Just one word with regard to these payments. I believe, a couple of governments you have outstanding from UP and Jharkhand, if I got that correct. You all have been assured that the payments start coming in from November. Is that correct? Because, I was in touch with various...
the government has always said that these payments will start coming. Obviously, they've not come at the pace that we anticipated that they would. But because they are central government projects and these monies are, central government funds, few months here and there, but we are sincerely hoping that by the end of H2 and beginning of first quarter next year, these monies should start getting normalized and the backlogs getting cleared.
Got it.
Okay, all right, Amit, we'll leave it there. Thank you very much for joining us. Good luck, good performance, and we wish you all the best of luck.
Thank you so very much.
To execute. We'll take a quick commercial break here. We're going to come back. Umesh Revankar of Shriram Finance joins in to talk about their second quarter results and, of course, the outlook going forward. Stay tuned. Coming up. Well, as promised, we have the management of Shriram Finance now joining us. Shriram Finance is the #1 volume-led gainer on the NSE right now. So it's a big name, second largest NBFC, and it continues to perform very, very well. So there you go on your screen, 5% on it, 6 million shares. So it's a big number out there, both on price gains and volumes as well. Umesh Revankar is Executive Vice Chairman at Shriram Finance. He's joining us now. Mr. Revankar, morning and congratulations on a good set. Prashant here. We're going to just highlight for our viewers what we're going to talk about. Asset quality, we want to get some guidance from you. Growth, of course, numbers going forward, and margin expansion as well. Maybe we will see more of it up ahead. Mr. Revankar, it's like it's been an up and up kind of trajectory for you now for the last almost 2 years. So it's been a one-way street. This quarter, I think what kind of stands out is that overall credit costs for you have remained very much under control, 1.78 compared to about 1.73% last quarter. When we spoke with other companies, in your peer set, some unlisted names, etc. as well, most people highlighted some stress in the commercial vehicle segment. it's not showing up for you. And CVs, by the way, is about almost 50% of your business. So I just wanted to start there in terms of what the, what's driven these numbers, especially on the asset quality front, and how you managed to keep it very, very steady.
Yeah, thank you. Good morning, Prashant. See, as far as our business model is concerned, we have a direct touch and access to customer all the time. And most of the customers whom we lend are individual and small SRTOs. And that's one big difference between us and many of the others. And the second thing, the asset values of the vehicles have remained very strong. It has not changed at all. That there is nowhere you will see idling of a vehicle, income getting reduced, or vehicle value coming down. So these three things are very important for viability in a CV business. And since we are in touch with the customer, we have direct access to customer, we did not see any stress as of now. Even the sales numbers, if you look at the first half in the sales numbers have gone up. The CV demand has gone up, even though most of the demand would have come in the fag end of September. But even in October, the year-on-year sales numbers have gone up. That means there is a significant demand for a commercial vehicle. The activities in the ground is quite good, and therefore I feel the business is good, and the customers are able to repay on time.
So that's the CV side of things, which you say is humming along quite nicely. I mean, growth has come across the board for you, right? Even in some of the other segments, for instance, MSME. And I think on the back of this, you are guiding for almost 17% AUM growth this year. So give us some more color on what makes you so confident that growth can be, it's music to the ears and your investors are loving it. Stocks up 5%. So give us some more granular detail on what makes you so confident about this kind of loan growth.
See, typically the festive period or festive time is the indicator of the mood of the customers. And this time around, the October has been all-time high sales number for all the segments, whether it's a passenger vehicle, commercial vehicle, two-wheeler, and three-wheeler, tractor. Every segment has shown big growth. Only one sector that has not shown a big growth or maybe even a growth is the construction equipment, where there has been some slowdown in the infrastructure spending, which is likely to gather momentum post-rains. Normally, post-rains, these infrastructure activities continues till the arrival of rains. So this time, the monsoon has extended. Therefore, there has been little slowdown, but I think that also will join. The other point is most of the demand coming from the rural side. When I say rural, I include semi-urban also, because that is where the hinterland, rural is a hinterland for the semi-urban area. And together, that demand is quite good. So I believe the credit demand will continue to grow, with October being the peak sales or peak demand for the business.
All right. Hi, Mr. Revankar. First of all, congratulations on a very, very good showing. No worries with regard to the numbers. But sometimes the street seems to be looking ahead and sniffing something more. Now, unconfirmed reports indicate that Japan's Mitsubishi is eyeing a stake. My question to you is, can there probably be a fresh infusion to pick up 20% stake? Because that's what the unconfirmed reports are suggesting. And sometimes there's no smoke without fire, right? You want to deny totally, you want to say that could probably be something in the works. Please go ahead, sir.
See, we are in discussion with many of the banks and institutions all the time. And this time we have not even discussed this in the board. So there is no question of raising equity at any point of time.
You're definitely denying that there's no talk whatsoever with Japan's Mitsubishi to come in and take 20% stake via a fund infusion. Is that correct, sir?
First of all, we need to discuss this in the board meeting. And since it has not come to the board, I cannot further comment on that.
But sir, you are saying that you are in talks with institutions. I don't know, is that a general statement that usually you're in talks with a lot of institutions? Or are there talks ongoing right now, but it's not come to the board level? And eventually, I mean, then it could come to the board level, right?
See, generally, as you rightly said, banks and NBFCs do look for raising resources all the time. It is your raw material. And therefore, there will be multiple discussion. And unless it is becoming a very confirmed or concrete structure or a plan, then only it will come to the board.
Is there a concrete offer, Mr. Revankar, that you know of?
There's no concrete offer.
Okay, got that. So we'll
But that could probably be something that we could hear in the coming month or two, right?
No comments.
Okay. I think let's just move on to the next one, Mr. Revankar, which is, of course, we've spoken about this earlier as well, a credit rating upgrade, right? What's happening there? I think we've asked you this before. When can we expect that? I mean, that perhaps a little bit more in your, not in your control, but you have to work with rating agencies. But should we see that AAA anytime soon, sir?
We are definitely working on it. We are working with the credit rating agency. We would definitely like to improve our rating because rating upgrade and AAA gives us a lot of huge opportunity in raising resources at a lower cost, especially sovereign funds or provident funds and insurance companies' investment. Those things comes at a much cheaper rate. Therefore, we'll be working on it. Definitely, the rating agencies are very positive about it, and hopefully, we should be able to go through that or get it as early as possible.
And got that as soon as possible, and you sort of obviously effort towards that. This is not in any way related to a potential transaction, Mr. Revankar, is it? I mean, a rating upgrade and then maybe some kind of a partnership. Is there any connection at all?
There's no connection at all.
There's no connection. Got it.
Final point on the fundraising bit, Mr. Revankar. I mean, just take us through the capital ratios as of now. I mean, purely from a capital perspective, are you fully covered for growth for, say, the next 1 to 2 years? Or could there be a discussion? Because, I mean, on the growth front, you're seeing very strong growth ahead. So is there need for growth capital, or do you have enough? And then if, then the capital raising conversations are more about building a buffer for the future.
See, statutory requirement is 15%. We are above 20 now. So we have enough buffer for the kind of growth which we are witnessing, around 16-17% growth. That is sufficient for more than 2 years. Okay. So I don't really need capital for the growth.
For that. Got that. So if anything, it might be, something more strategic, and you will tell us more when it comes to the board level. Take that point, sir. So I just want to now, get back to the business and margins, because that's another very heartening, point when we look at Q2, because while most lenders have had some compression here and there, you managed to grow margins by about 8 basis points. So just tell us how things are moving, both on the cost of funds side and on the yield side. And I think you're saying by the time the year ends, you will be higher. The exit margin will be higher versus where you are right now. So just give us some details.
Yeah, see, the cost of fund in our books today, as it stands, it's around 8.83. We have improved from 8.89, around 6 basis points we have improved. Incrementally, we are borrowing at around 8.3 if you look at the number in the last quarter. We would like to improve it further. So as we keep repricing the existing borrowing, because 87% of my borrowing in the books is fixed, 13% is floating. The floating one will keep changing depending upon how the banks transmit. But as far as the fixed is concerned, it depends upon how it gets repriced at the time of maturity. So as we reprice it over the next 2 quarters, the cost of borrowing will come down, and that will flow into net interest margin. However, at some part of it will definitely be passed on to the customer as a goodwill gesture, and also to expand our customer base. So that will be done at the appropriate time. However, we would like to keep growing our net interest margin to around 8.5 level by the end of the financial year.
Absolutely. Mr. Revankar, just one personal change, right? So we have the current CFO is going to take over. Mr. Parag Sharma is being promoted to MD and CEO with Mr. YC Chakrabarti, who's after his term is completed this year, right? I mean, later in December.
Yeah, it is later in December. See, we have a very strong senior team, and a succession plan is I should say, well planned much in advance. And we do have a lot of other senior teams which will come into board. We will also have two COO coming into the business centrally, because they were managing it in the various geographies. They will be moving to Mumbai, and this business will be managed centrally. Because we felt that the central team need to be strengthened further to know what's happening in the ground level. We also have people we had 5 geographical unit earlier. We have made it 10 now. So there will be larger...
what about Mr. Chakrabarti, sir? Will he be with the group?
He'll be with the group. He is part of a senior team.
Okay.
So he'll be remaining with the group.
Okay, so 2 new chief operating officers, CFO being promoted, so internal long-serving members being promoted and elevated. Thank you very much, Mr. Revankar. Great speaking with you. Really appreciate it, and good luck as you continue to execute very, very well. So that's Shriram Finance. Stocks up about 4.5% as things stand right now. 20-odd points. The market, of course, now coming up quite sharply from the lows. 25,750 is where we are at, which is at the day's highest point. Surabhi.
Okay, so that's the market for now. From finance, we are moving to food and FMCG. Patanjali Foods is the next stock on our radar. Now, it was a pretty steady quarter for Patanjali Foods as well. The profit was boosted by a 141 crore rupee tax credit. And then the weakness in edible oil margins was offset by strength in FMCG. We have with us Mr. Asthana, CEO at Patanjali Foods, joining in. Mr. Asthana, thanks very much. Good to have you in. So I'm just breaking down the numbers for our viewers. Overall, your revenue is up 21%. Your margin is pretty steady at around 5.6%. But if I break down the segments, then there is margin improvement in FMCG. I think your margin's gone from 10% to 12% over there. But there's some pressure in margins on the edible oils business. So let's take it step by step. Just walk us through what's happening, first of all, with the whole GST transition. Is all that behind us? Did that have any bearing on your, either arms of your business in Q2? And then how are you looking at growth in the second half now? First, at the headline level.
So headline level, just a quick one on the numbers first. So on edible oils, actually, we have improved from Q1. This quarter, we did nearly 3.53% of margin, EBITDA basis, which is pretty much in the ballpark range of 2 to 4% that we typically do. FMCG, we have consistently maintained that we will be upwards of 10%. We have consolidated the numbers between the HPC and the food, so it's about 12.23%. And on a net basis, also, we are pretty much about 6% plus on the EBITDA margin basis. So broadly, the numbers are pretty positive. We are very confident. Coming to the GST part of it, yes, the impact is there. We can witness it. But as I've consistently maintained, that these are food sort of products with the price points and at the level at which it is. The instant uptick is very difficult to get immediately. It will take a couple of quarters. But our estimation is that on an overall basis, by the end of this year, we should see 300 to 400 basis points of uptake on the sales part of it. So the revenue should definitely get the GST boost of that over and above the volume growth that we're targeting in foods and HPC. So that should be pretty much there.
Okay, so you're saying 300 basis points uptick at a revenue level, that would be on the FMCG side, right? So there'll be a 300 basis points GST boost when we look at the full year pictures. Just going back to margins, as you explained, now that you've consolidated home and personal care and with the FMCG, so this 12%, is that a steady state expectation that one can have? That 12% is going to be the new normal for your FMCG business?
We should get actually better than that because this quarter, some of the overhang of the foods continued. And so those corrections are getting taken. So I think pretty much in the ballpark range of 12 to 14% is what we're targeting. And it won't happen immediately because there is still some bit of overhang that we're witnessing post the festive season. So typically things tend to go down a bit, immediately in November and part of December. But broadly, that is the target, that between 12 and 14% on the HPC will maintain, between 2 and 4% on the veg oil side, but pretty much at the higher end of the band. If we can do that, then that will be very positive for the company.
Just to reconfirm, sir, what is the likely edible oil margins in the second half of the year? Missed that number?
We are targeting pretty much close to 4% is what the upside target is. The markets are looking positive. That's very supportive to the overall price points. And we are reasonably confident of pretty much remaining at currently at 3.53%. The second half tends to be nearly 2/3 of the sale. So I'm quite hopeful that we should be pretty much closing closer to 4%, if not exactly 4%.
Okay, all right. And what about FMCG? By when does it become 50% of of your mix? You've been guiding for that. You've been making strides in that direction. But by when does it take place?
We are making, Nigel. For example, this HPC business post the consolidation, there was a spike in the veg oil prices because of which the percentage-wise, it is still close to 70-30. But my hope is that in 3 years' time, at a target basis, that we should be pretty much close to 50-50, both for FMCG and edible oils.
And individually, for the home and personal care business, I don't know if it makes sense now to look at individual margins because you're talking consolidated as FMCG as a whole. But at an individual level, what are the margins of that business? What do you expect for the second half?
So the margins have been very positive on the HPC side. I think owing to some of the price point changes that we did and some of the gains that we got on account of the purchase efficiencies. So it has been 22% plus on the home and personal care front.
And that is to be sustained?
We would like to sustain it. Margins typically, the ballpark range has been close to 18%. So this is more one-off benefit that we typically got, post the acquisition in last quarter. So I don't believe it will be as much as that. But between 18 and 20%, we are pretty confident of maintaining.
Okay. So just to revisit, like you told us on the edible oil business, you're looking at targeting 4% margin, and FMCG, the blended FMCG with HPC. What would perhaps the exit margins be, likely exit margins for the FMCG business for this year?
So this consolidation process is still on. We so currently what you're seeing 12.2%. This we'd like inching closer to 13% plus. And because we have only half a year, for the numbers. And next year, we certainly want to cross 14% on the FMCG overall on a consolidated basis. And 4% we are targeting for the veg oils.
Okay, all right, Mr. Asthana, we appreciate you joining in. Wishing you all the best. You're sounding optimistic about the second half of the year. We'll hold you to some of these numbers. Wish you a good day ahead, and we catch up soon.
Thank you.
Well, let's welcome the next management, Kabel. The stock is strong in trade. They reported actually a good set of numbers. Strong growth, good margins as well. We're now joined by Mr. Rajesh Jain, the Chief Operating Officer at Kabel. Hi, Mr. Jain. Good morning, and congratulations on a good showing. When the markets opened up, the stock was much higher. Now, in fact, it's cooled off a little bit. That aside, if you could tell us, about the growth, because I was looking at some of your peers in the cables and wire segment, and you have actually outbeaten them. So could you tell us what worked for you? This volume growth is good. Have you gained market share? Point number one. Point number two, margins are looking good, but copper prices have moved up. So do you think you can maintain the same margins, or do they trend down a little bit from here?
Yeah, good morning, and thanks for giving me a chance to give my views. So here, if you see our volume growth are very good and in line with our Project Rise planning, what we have done in the beginning of the year, and with our strong initiative in terms of volume growth and margin improvement, we are on line with those plans. When we compare with industry, yes, we have done fairly good both in domestic as well as export market, and it is backed with the volume growth as well as whatever there is price rise also in good copper and aluminum prices.
Okay, so what should be the rough trajectory then, sir, from here? And market share, do you have a number? What kind of market share you had, say, a year or so ago? And since you're growing at this pace, have you gained some?
Yeah, in market share, there may be some impact, but not majorly. There will be not that much impact. But of course, since we are doing positively, so it will have a improvement in our market share. Even at year end, we are looking at good volume growth as well as margin improvement by year end.
And market volume growth is 18% for the year, right? That's what you're guiding for.
That's what we have planned.
And consolidated margins will be around 8%?
Yeah, consolidated 8%, but within wire and cable, it will be like around 8.5%.
All right. And the smaller part of your business, the FMEG business, you were guiding that it breaks even, right? Second half of the year, it moves into the green?
Yeah, by quarter end ending March 26, it will be at break-even level.
Okay, Mr. Jain, morning, Prashant here. Just, so the one commodity on which there is consensus optimism, it is copper. That it is beginning a new, same kind of optimism we had about 2.5 years back. And then, of course, I mean, copper prices topped out, but we're back. We're at all-time highs. I remember speaking with cable and wire companies back then. And at that point, I remember some saying that if there is this, a big rally in underlying copper prices, demand does start to get hit. Across segments. I mean, it becomes, for a lot of end industries, it becomes not unviable, it becomes much more expensive. So I just wanted to, it's a general question, not so much about RR Kabel, but how does the business work? Because you're at all-time high copper prices, and presumably they're headed even higher.
So first, it is very hard to predict how prices will move. And but one thing, though, raw material copper is the very big raw material and an impact in our costing and as well as revenue growth also. But at the same time, see, the demand remains on the other fundamentals, how construction activities are going or how industrial growth is coming. So in short term, there may be a little bit impact, but in longer term, there will be no impact, irrespective of copper prices, how they move.
When you say short term, there may be some impact. I mean, just you're talking in the ballpark. I mean, what can we expect? I mean, if you want to talk about your company or overall.
No, in short term, I mean to say if there is, say, a sharp movement either upside or downtime at industry level, there may be some impact. In short term, it means there may be like people take some time to settle down, but it is not like that at the industry level or even for us, there will be any major impact in demand or growth. That's what I want to say.
Okay, all right. If you could help us out, sir, with regard to the export market as well. I think exports in the past quarter, I think the shares stood at around 25%. If you could help me out with that number, and on a steady state basis, how do you see the export market shaping up? Because there's so much of uncertainty globally now.
Yeah, so export is contributing almost 27-28% in our overall business. Yeah. And we have seen a similar growth in my domestic as well as export market. Yeah, we have seen so much uncertainty, particularly about US market. But since US is was contributing almost 8 to 10% in my export business, but the same thing we have compensated through other markets, and we have not seen any major difference or deviation from our export planning.
Okay, so exports, you're not too worried. But what about the two big players who are coming in there? The Birla Group as well as the Adani Group, both of them have announced that they are eyeing your sweet spot, cables and wires business. Don't you think competition is going to get a little bit more fierce and that could make life difficult for a company like yours? Or do you think the market is big enough and everyone can prosper together?
First, yes, market is of course big enough. Like India and this industry is expected to grow at in double digit 14-15% at industry level. So of course there may be some competition, but we have to focus on our product, our strategy, and our distribution network. So we'll keep focusing on that, and we will have our own growth.
You don't fear a pricing war or something because they have the deep pockets?
No, that is, see, everyone has their own brand positioning and brand placement, distribution network. So with that, we have our own strength, and we'll work on that only.
Okay. All right, so we'll leave it on that note. Thank you very much for joining in, and good luck to you for the second half of the year. That's RR Cable at the end of Q2. All right, let's get back to the market and see what the movers and shakers are looking like. On the large cap screen, it's really, still very much about Shriram Finance. And a couple of these auto counters. that are still up and about. M&M, for instance, is up 2%. Sud was earlier telling us that I think on SUVs, it's been, again, breaking previous records. One of the highest, monthly sales on SUVs. I think it's more than 30%, if I remember the number correctly. Maybe we can get Sudarshan back up. Titan is a little quiet ahead of its numbers this week, 1% lower. That's what we have for the timing. Godrej Consumer, by the way, another one that's reacting very well to numbers. Godrej Consumer is now flying 5%. And speaking of flying stocks, we all remember what Naveen Fluorine did on Friday, right? Look at Naveen this morning. What a move on Naveen Fluorine. I think all put together, it's almost 20% since the numbers came out. 5% again this morning on Naveen Fluorine.
Yeah, just a small name is Dredging Corporation. It's a PSU. It's a 2,000 crore market cap company, and it's flying away. It's done very well. 650 last week, beginning of last week. It's at about 800 and almost 900. So as I said, look at the volumes. It's not small. Some large amounts of memorandum of understanding with lots of companies, PSUs and private players. These were all public exchange notifications over the last couple of years. And there you go. That's at the bottom of the screen as well. So some MOUs worth 4,000 crores in which dredging will participate. As we'll try and actually reach out to the company and see if they want to speak. We'll take a quick commercial break here. On the other side, Manisha Gupta will be focusing on the commodities. What's top of mind? Stay tuned. Coming up.
Welcome back. It's quiet at the headline index level. It's all about individual stocks today. So let's now turn our attention to the commodity markets and see what's happening there. Manisha, good morning. Monday, what are the cues and what's topping the attention list for you?
Well, metals clearly, and within that as well, I'm going to look at gold and copper, which is started as the next gold. I'm going to talk about both of these commodities right now. Gold first, and we are trading at around $4,000 an ounce. There was a knee-jerk reaction. We did see prices go down. Actually, for the month of October, when you look back at the month, we did see an all-time high of 4,380, and then we did see a correction all the way up to 3,925 on the lower side as well, holding around $4,000 an ounce at this point in time. Well, there has been pressure, of course, because of expectations of diminished further rate cuts, especially for the month of December, as the US Fed chair has spoken that it's not a foregone conclusion that you will see a rate cut coming in for December. So while before Powell spoke, before that, the possibility of a rate cut for the month of December was at 90%, which now stands at a 70%. So that's what's bothering the gold bulls right now. The other thing also is about the US and China trade deal that is lent more money to risk-heavy asset classes and not so much for safe haven there. But more interestingly, what has happened over the weekend and that the markets are keeping a keen eye on is the China Finance Ministry coming out with a notification that says that all buyers, retail buyers, that is, whether it is about investment, jewelry buying, industrial gold buying as well, the tax incentive has been scrapped starting 1st of November. Now, this means that starting today itself, you will be looking at gold prices increasing for consumers in China. That also says that whatever gold is being bought from Shanghai Gold Exchange, the VAT offset that the retailers were getting, they would not be getting now. A positive that we've seen in the other regional markets come in, that perhaps Chinese consumers will start buying in from other countries. Now, this could be for India, Hong Kong, Singapore. These are the markets perhaps China would buy because of the tax, easy or lower taxes therein. So this is something to watch out for in the coming days there. The other thing also comes in from China, where the China state-backed Non-Ferrous Metal Industry Association says that you could be perhaps looking, or they have proposed actually, setting a capacity cap for various metals like copper, lead and zinc. Now, the reason that China Association is doing that is because there has been lower processing fees, and that has continued to hurt the smelter profitability in last couple of quarters, as we have seen. So much so that the association has not even put in a guidance on what the fees is going to be for the last quarter of 2025. And this is perhaps happening for the last 3 quarters now. Copper concentrate processing fees is at a record low and has been for the last couple of quarters. That is because of the scarcity of concentrate availability into market. China also has seen coal, solar, steel sectors struggle with excessive supply, low profitability and lower prices as well. So when you look at the overall prices right now, they have continued to decline. Remember, China did put a cap on production in sense of aluminum capacity at 45 million tons. This was done way back in 2017. 45 million tons has been hit in last year. So that means China would be curbing production of aluminum starting into this year. This is what we've done in sense of prices, really. So while gold and silver continue to shine, in this year we've seen prices gain up by 53% for gold. 70% is back in case of silver as well, as we see stability coming in for both of these metals. And then take a look at the base metal prices. But within that, you've seen tin outperform, and then it has been copper with 27% of gains. And positive cues continue for other metals as well, barring steel, which is in negative for this year. And then coal, of course, is down 13% for the same time.
All right, Manisha, thank you very much for that. That's commodities in focus. We'll take a quick commercial break here. Lata in conversation with the management of Bank of Baroda on their second quarter numbers. Stay tuned, coming up.
Bank of Baroda stunned with its margins increasing by 5 basis points to 2.96%, whereas the street was expecting a fall in margins because of this huge 100 basis point cut in the repo rate that the Reserve Bank did in June. The other, positive surprise is the improvement in asset quality for Bank of Baroda. As a result, the credit cost, which is the cost of providing for bad loans, has fallen sharply. Now, the worrying bit is how does the bank prepare for the next expected credit loss regime, where you have to set provisions depending on what you expect in terms of a loss. The bank has said that their provisions will increase by about 22 to 25 basis points, which means we have to prepare for an increase in the provisioning. For all the short and medium-term questions on BOB, I'm joined by Managing Director and CEO, Mr. Devdutt Chand. Mr. Chand, good morning and thank you very much for joining us. Well, many congratulations on the NIMS. That has taken the market by a very positive surprise. Can you tell us what would have been the NIMS if you didn't get that income tax write-in? Therefore, if there is no write-in in the second half, may the NIMS fall?
Hello, good morning and thanks for inviting me. And let me tell again, we had a good quarter in terms of both top line and also bottom line. And asset quality is one of the best in many quarters. It is the lowest point now. So particularly on the margin side that you talked about, yes, this is a normalized quarter. And in the normalized quarter, what is positive is the NII growth that the bank has given. So it's something contrary to the market in terms of giving a NII growth. Yes, there is an impact of this income tax refund, and the gap is hardly 350 crore quarter to quarter. Every quarter we do get something. But if you adjust that also, the impact would be something around 7-8 BPS on the NIM that we have declared global. On the positive, which again I say, apart from the margin that we talked about, the NII is positive. The cost of deposit is all-time low at 4.91. Last time also I said that we were going to pierce the 5% mark. And I would say that the prudent liability management and the asset management is leading to improvement in the quality in terms of asset also, at the same time protecting the margin also.
Okay, well, let me just persist for a minute. You are expecting income tax refunds in the coming quarters as well?
It is. Every quarter we do get some amount. Sometimes it is higher or lower. This quarter, it is higher than the last quarter by around 350 crore.
Yeah.
Every quarter we get something, and last quarter also we had something.
Oh, okay. So you're confident that you have seen the worst in margins? Second half will be higher than first half?
See, I said...
assuming no rate cut, I mean.
Yeah. Assuming no rate cut and everything stands as it is, I think we have seen the lowest point in terms of pricing, both on the deposit and also lending, barring the MCLR.
Okay.
At the same time, the impact of this repricing would have happened in the quarter at different point of time. So some of the asset liability, possibly the impact would not have been felt for the full quarter, which is going to be the full quarter next quarter.
Okay.
That's why I said while announcing the bank's result, the next quarter, the margin is going to be range bound.
Okay.
And as far as Q4 is concerned, definitely it would be upward bias.
Okay.
So full year basis, we said the margin would be 2.85 to 3%. That's a guidance.
Yeah, that is flashing as you speak. We have your margins. I just wanted one more word on the cost of deposits. Your bulk deposits are still 17% of your total deposits. Are you, of course, there you have said that your bulk deposits include CDs. Is there a way of reducing the non-CD bulk deposits that can improve your costing?
It is so. If you look at almost like last 2.5 years, we have been guiding that we want to reduce the dependency. Earlier, if you look at a percentage of bulk as a percentage of total deposit, it was quite high. So we wanted to reduce that because it is a volatile component and always there is a price sensitivity to it. Mm-hmm. So as on today, the impact that you are seeing on the margin, the NI, everything is because of the prudent liability management. Mm-hmm. In the current composition of the bulk and CD also, there is a higher percentage of CD, the certificate of deposit. Okay. The term is less and the pricing is also less.
Okay. No, if it is CD, it's not a worry. It is just that you'll have merged it and presented the data. I wanted to know a bit about loan growth as well. Your total advances growth is about 60,000 crores compared to a year ago. But a good 30,000 crores has come from corporate, which is a little unusual. If you see quarter to quarter, your Q1 over Q2, there is a big jump in corporate loans. Why is that? They don't normally pay well, isn't it? MSMEs and retail, the return is better, the yield is better. Which sector is this, and will not that impact margins going forward?
Let me put the context therein. Actually, our overall growth on the advances is almost 13% YY basis.
Yes.
In that, the RAM is almost growing at 16%. The retail is growing almost 17.5%. The agri also has grown at 17.2%. Similarly, the MSME almost at 14%. On a YY basis, the corporate growth is only 3%.
Yes.
Sequential basis, the corporate growth is 8%. So in terms of the growth of the bank that we are looking at on the advances, be it for Q3 and Q4, the full year again, we are keeping the guidance that the same 11 to 13%. And the RAM continue to grow stronger, maybe 15 plus, whereas the corporate full year would be something around 10 to 11%. So in that way, our incremental, what you can say, the advances would be more towards the retail asset, the MSME advances, the agri advances, as compared to corporate. But corporate, we want to do better than on a YY scale. Sequentially, it is very strong. So there are pockets we are seeing there is a good traction therein. And we typically, within the book, we look at a core corporate and the refi deal. Slightly on the refi deals, we are slightly restrictive because that's a very heavily competitive market with a lower pricing. So we are mindful of the margin, and that's why, what I say now, you can very well imagine the NIM at 2.96. That talks about our prudent management on the asset side, particularly on the corporate loan book also.
Okay. Well, it's still, it's eye-popping. Only 3% maybe when you say that, but you look at 8%, 3.7 lakh crore has become 4 lakh crore. So it is a 30,000 crore jump, which wants you, which makes you wonder, whether you'll be able to maintain margins. But let me come to asset quality. MSME numbers, of course, keep coming up. They are the highest part of your stress. Are you worried that it might increase? Can you give us some guidance, or are you MSMEs and agri loans, any worries at all?
No, I don't think so. If you look at the fresh slippage data that we have given, that is almost 2,669 crore. It's lower than the last quarter fresh slippage and also the lower than the same quarter last year also. So that's something that we are talking about the asset quality. Inherently, the quality is really good now. At the same time, if you look at the fresh slippage, the component wise, both under retail and MSME, it is lower than that of the last quarter. Agree, there is a marginal slippage over there. So in terms of the overall book, in terms of the SMA book, we only declared the more than 5 crore acrylic SMA 1 and 2. But internally, when we look at the SMA book, this book looks quite good. So in terms of the asset quality, I don't think there is any pressure, particularly the segment of...
Not even in agri, which you admitted.
That's marginal. 100 crore for a book like us is a marginal number.
No, I agree.
That's not... No, I mean, at the same time, the denominator is also increasing, you believe. So in terms of the GNPA per se on a component of agri also would be lower than that.
Okay. Let me come to recovery from bad loans. Overall, your GNPA is like a very good picture, nothing to worry. But recovery from bad loans obviously is falling. Should we expect any positive surprise there? Because you have some 42,000 crore in various NCLT proceedings. Is there a positive surprise likely? Because all of them are written off.
See, we said earlier also our normalized the recovery out of TWO is roughly around 700 to 750 crore. And this quarter, it is slightly lower at 483 crore.
Yeah.
But going forward, we want to maintain the normalized. One-off is always contingent upon host of factors, including the processes and many things. Look, the Q2 of last year, we had a significant one-off. That's why when we compare the net profit, we say there is a YY negative. Whereas suppose I adjust that, then the net profit is almost 22% of positive growth this year.
Okay.
So one-off is always we have a good kitty, but then these are again sticky accounts. But at least one thing that I'm pretty sure that going to be, we can maintain our normalized 7 to 750 crore out of the TWO account, recovery of the TWO.
Okay. Oh, that's good to hear. Very quickly, the two major changes announced by Reserve Bank on expected credit loss provisioning. You said your provisions will increase by 22 to 25 basis points, your credit cost, sorry. Exactly what will the impact be, and for how many years will this be, this likely increase in credit cost?
Look, there is a one-time impact and there is a recurring.
What is the recurring impact, sir?
Recurring, we said the credit cost can go up by 20-25 BPS once, the ECL...
For 1 year or couple of years?
It may, we'll just look into that. It's a very provisional back of the envelope calculation as on today. One is that I said the impact, ECL impact on the CRAR is going to be 1.25. At the same time, the lower, the RWA because of the credit risk, which has again also being announced, that is going to give a positive almost 60 to 70 BPS. So net to net, it would be something around 0.75 on the CRAR, which would be again spread over 5 years' time. At the same time, the recurring would be the credit cost can be 20-25 BPS. That's why, in spite of all this asset quality that we have announced this quarter, we kept the slippage ratio guidance and the credit cost at the same. The slippage ratio guidance is 1 to 1.25.
Okay.
Credit cost would be less than 0.75.
Okay. So that includes the ECL impact.
I mean, probable it would include that part.
Okay, got it, sir. The final question is on these ECL guidelines. The ECB guidelines. Now, foreign branches of Indian banks can also participate in acquisition financing, and banks also can participate. Of course, they are draft rules. Now, you have, a fair good network of foreign branches. So, say 1 year down the line, when both these draft rules become permanent rules, will you see more money made out of that acquisition financing?
I would not put it as a money made, but then there is a good opportunity for a bank like us to play a significant role therein. We are there in international market, and international market, this is established product. So we understand the market, we understand the product. So in that way, once it is implemented, see, we have a large book also domestically. My international book in rupee terms is almost 2,20,000 crore. So in that way, I think it's a very good product that need to have. As India getting into a mature market, I think we need to have this product. And once it's rolled out, I think a bank like us would be having I'll not put it as an advantage, but an opportunity for us to play a significant role there.
Okay. Yes, I guess there will also be advantages when deposits insurance becomes market-based. You may perhaps have lower costs, but those are yet shooting in the dark. We'll have a longer conversation some other time. For the moment, the market has given you a huge thumbs up. Your stock is up 4.4%. Many congratulations, Mr. Shah.
Thank you very much. Thank you, Lata. Thank you.
We wrap up on Bazaar on that note. Chartbusters coming.